Tariffs are starting to hit, but it's not the checkout line yet. July's producer inflation, or the PPI, came in way hotter than expected. Core PPI rose 2.8% year over year and 0.6% month over month. That's double what markets were looking for. Just a quick refresher. The PPI tracks what domestic producers charge for goods and services. Think wholesale prices before they hit consumers. The CPI is what you pay at the store. So earlier this week, the CPI was higher, but pretty tame. But now the PPI is telling a different story, and tariffs are likely the reason. Here's what we think is going on. Tariffs have been in place for months, but retailers may still be selling older pre-tariff inventory. Producers, on the other hand, are now getting hit with higher costs and starting to pass those on to the retailers. Retailers might be eating some of those costs for now, but that can't last forever. So the big question is, when will it hit consumers? Probably later this year, especially now that businesses have certainty about tariff levels and can plan for higher prices. So what does this mean for rate cuts? Well, investors basically shrugged off this report. Markets ended flat, yields ticked higher, but the odds for a September cut only slightly dipped. However, the next inflation readings are likely to be a big deal. We'll get July's PCE at the end of the month, then August CPI and PPI right before the September Fed meeting. If consumer inflation heats up more, or if this PPI spike turns into a trend, the Fed could think twice about cutting rates. For now, this might be the canary in the coal mine or just a flash in the pan. We'll be watching. Stay tuned.